So now that we're finished with the accounting cycle, we move on to merchandising inventory, merchandising companies, how to account for merchandise. So I think you're going to find this chapter more interesting just because it's a little bit more practical. You've been to many different merchandising retail stores and it kind of makes sense to you because you actually use and consume these products. So we're going to be covering a lot of different things in the merchandise inventory chapter. And the first thing I wanted to do was just point out the difference between our service and our merchandising companies. So like service companies, of course, they perform services, they collect those receivables, they earn those revenues, and then they eventually collect cash because of it. And these service companies are companies like tax companies, so preparing taxes maybe for corporations, individuals. We might have lawyer services, an LLP, which is a limited liability partnership. We could also have a consulting, or you just might bundle consulting, auditing, and taxation and just have a public accounting firm. So there's many different types of service companies and they all provide services. They don't sell any goods. But merchandising companies, what they do differently is they sell goods and they buy inventory. So they buy inventory, they sell inventory, and then the final two steps are the same as a service company. They collect those receivables maybe through credits, or they might just collect it in cash or debit. So basically the cycle for a merchandising company is a little bit longer, while one extra step because they have to purchase inventory, while the service company has a shorter cycle to actually collect cash. And there are different strengths to these different companies. Service companies, obviously, there's no purchasing of inventory. They don't have to worry about inventory turnover. They can essentially hire very strong applicants to provide great services and earn high revenues for their corporation, company, private company, whatever. Merchandising companies, there's a lot of strengths with these too because they can really just like mass produce, well not mass produce, but mass buy many different products, and if they have really quick inventory turnover, which is selling goods at a fast rate, they're going to be able to actually realize a lot of profits in general. Like if you think about companies that are really huge in market value, you'll see what I'm talking about. Like Walmart, absolutely huge. Target's huge. We also have let me think, Best Buy. So all of these companies are very huge and they know how to push inventory right out the doors by selling it, offering discounts, and just planning for the consumer and trying to create demand for those goods. So merchandising companies, you can really create quite a lot of profit and market value for your company, while service companies might have a little bit more difficulty because they can't just mass produce services, right? They have to have a person to actually perform the service. So there are strengths to each different type of companies. So let me just say that when we do have merchandising companies, what we are going to notice differently is that we're going to have a few new keywords that we're going to have to learn. And since merchandising companies, basically, since they buy inventory and then they sell inventory, what they're going to have is they're going to have one extra expense that service companies do not have. And this is going to be an expense called cost of goods sold. And you can think of that as an expense for all of the goods they sell, right? And basically, that is just an accounting term to represent goods in their inventory which they sell. I'm kind of repeating myself there. But yeah, that would be an expense on a merchandising company's income statement. So you're going to have to know this as an expense, and you're also going to have to know, one, one new term which is also something called gross profit. And gross profit is an accounting term which is just the difference between sales and cost of goods sold. And why would we have this term? Why would we create this little step here? Well, like gross profit, if you think about it, cost of goods sold represents inventory, right? So if we look at gross profit, it's going to give us an idea of how much profit we're deriving on each unit that we sell, because the sales will be from units of product and the cost of goods sold is our expense for each unit. So the gross profit will show us how much profit we yield from inventory. So when we have a very high gross profit margin, that means that we are receiving more profit on each unit that we sell. And if our gross profit margin is low, it means that we are obviously having less profit on each unit that we sell. So basically you can look at the gross profit and you can kind of try and strengthen that margin by doing certain accounting changes, or you can try to actually purchase cheaper goods. So gross profit is a constant element that a company will look at and that you'll have to know for your accounting tests or quizzes. So basically that's pretty much what I wanted to cover. I just wanted to cover a very general overview of the difference between merchandising and service companies. We're going to be learning a lot in the next few tutorials. We're going to be looking at many things like the difference between perpetual and periodic inventory systems. We're going to figure out how to do all the accounting for all those different transactions like discounts and returns and sales, expensing the goods. So you're going to have a lot of fun with that. And, whoopsies. And yeah, basically I think that's it. So in the next tutorial we'll start talking about perpetual and periodic inventories. I hope to see you guys in the next one. See you guys later. I'm sure you guys have questions regarding the accounting topics or our videos, so make sure to tweet us at #iNinjaNotes, like us on Facebook to receive updates or to share any quick anecdotes about how our videos might have helped. And like always, thanks for watching us on YouTube.